Hey, everybody, welcome back. Today, we want to talk about something that is becoming more and more front and center of the American populace mind. That has to do not necessarily with COVID. It's actually starting to change according to some new research that's come out. The number one topic, which is equal to or more important to Americans is not COVID. It's increasingly becoming something that you and I have probably seen more and more is inflation. Food prices are up, energy prices are up across the board. We're really starting to see that common goods and services are going up in price. And so repeatedly for months and over the past year and a half, since we started to kind of ease the monetary policy and the Fed has been actively, pumping dollars into the system, so to speak, or printing money or whatever it is that they technically do, we have seen the bubbles inflate all over the place. So, oh, well, the Fed doesn't actually create inflation. Well, if you look at different things, the excess capital jumping around is very obvious. I mean, you look at real estate, prices have completely inflated because of low rates. What other things have done? Well, people are stacked with cash. There's been a lot of money moved in the system. Stock market is at all-time highs. And again, interest rates are at all-time lows. So we have a very interesting piece. And then you add in like difficulties with the supply chains across the world. And that has also sparked price increases. And so while you do see commodities like wood and brick and things like this are going down, one thing that a lot of people are not thinking through or starting to realize maybe now is wage inflation, right? You're starting to see these openings, millions, tens of millions of jobs open in the US economy, but nobody is taking them. Nobody. So if nobody's taking them, what's getting people to come forward? Well, people are starting to raise their hands and say, yes, I will work, but I want $25 an hour, some benefits and some other options here that are going to make my lifestyle worth it. And while that is good and dandy, eventually companies, restaurants, businesses can either choose to absorb some of that inflationary cost, but eventually they have to pass on the cost to the consumer. So, if you're following some of the reports that are coming out of the stock market, like Procter and Gamble and Home Depot, Costco, some of these other big box store retailers, they're talking about how they're having to pass on the price inflation to the consumers. So costs of goods are going up. All right. So if you're following along so far, you're in agreement with me. You know that things are more expensive and they're going to continue to become more expensive. Why? Because I'd mentioned before, as wages increase, things are going to be baked in. That is the cost of goods. If you're paying your servers $25 an hour plus tips, well, that has to get passed on somewhere. So now your cheeseburger, I even read this morning, McDonald's is going to start raising their prices. It's inevitable. Things are going to cost more. The sad news is that while inflation's hovering around 5%, which is reported, you and I probably believe it's somewhere close to 7 to 8% really. But if it's reported at 5%, I think wages are only going up at 3%. So you're seeing how there's actually a net loss. The middle class and working class are going to get crushed because they simply can't stay ahead of the curve. So, all right, Arthur, you've talked a little bit about how inflation is a real thing. And you've also explained, I've explained that inflation is probably not going to go anywhere because when you factor in wage increases, that is going to be now baked in moving forward. That is the new standard as we continue to progress. Now, I'm not here, again, you know me, I'm not here to say that's good, that's bad. In fact, I would probably say for the most part, this is actually good. But if you're following me or you're curious about my thoughts here, you want to know what's in it for us. How do we proactively think about how to protect ourselves in a high inflationary environment? So wanted to give you a couple of thoughts on this. So if we look at the 70s, we think back to what did well in the 70s. There's a couple of things. Well, one, gold did very well. So, hey, there's a good chance that could do good again. I'm not a gold bug, don't know much about it. Probably not that difficult. If you do buy it, try to get the physical stuff and lock it in a safe somewhere. But there's companies that will hold it for you as well. So gold did really well. Real estate did extraordinarily well, did very, very good. You're talking triple in a 10-year period. Real estate values actually tripled. Okay. Well, if you're following the channel, you know that I'm a real estate bull. I love that stuff. So I think that is going to continue to be one. But I think the bigger picture from what I've read from other analysts, the idea is if you can attach yourself to a cash flowing business or asset, that is one of the best hedges against inflation. And I'll give you a bonus one on top of it. So what am I doing? Where am I going with our money here as our family is thinking about navigating the next few years of this crazy inflation? Well, I think when you're thinking about cash flow, yes, we're going to talk about real estate. You know, I'm a bull. You know, I love that stuff. But what else, right? Because real estate is not the most inexpensive or liquid asset to get into. It's a pretty big insurance cost. So stocks would not necessarily be a bad bet, but here's the kind of stocks I would be thinking about. And again, I'm not giving you advice, but here's what I'm thinking about. Cash flowing stocks. Well, what are the types of companies that can pass on incremental cost increases without the customer base getting too riled up? So my mind instantly goes to cloud stocks, right? If you're thinking about Google, Microsoft, Amazon, right? These are the bulls. When you're thinking about infrastructure as a service, they have the platforms, they have the infrastructure, they have the largest base, and there's a huge market cap on this stuff. So look, if GCP decides to increase costs by 5% to pass on whatever the new cost of their data centers, I think their customers, because of how intricate these microservices are, it's just something that customers will absorb. AWS decides to ratchet up a little bit more or increase their costs. They could easily pass that on to customers, and it would be very hard for customers to move away. Microsoft, same thing with Office 365 or Azure. These products can absorb, one, there's a lot of margin in them, and two, they can actually increase the margin by upping the price, and it's not going to impact them very, very much. So I'm very much thinking these are Apple's another one, right? Customers are used to paying a premium for these products. So if there's a chip shortage or things are going to be expensive, customers are already going into the mindset that I'm going to have to pay a premium. And Apple also has, by the way, a very nice platform as a service subscription model with Apple TV and iPhoto and everything else that they have in their ecosystem. Well, I don't personally subscribe to the Apple ecosystem. I can appreciate the intricate detail on why it's so difficult to actually get out of and why it's so good to be inside of it. Okay. So I think tech stocks with the right type of flavor are good. So you got to think core. Because if we start to go into some sort of recession or a stagflation environment, these kind of ancillary SaaS products are probably going to be less interesting to people because they strip back. When we go into recession, people go to the core, and infrastructure tends to stick. It's the backbone of every business, and it's the one thing that will get stripped out. So, marketing, SaaS products, things of that nature, those are usually the first to get ripped out. So anyway, I would say those are the types of stocks to think about. REITs are another one, right? Real estate investment trusts, great products to buy. I think we're going to see the rental market continue to increase. Okay, so those are some ideas of some places to put some cash. Index fund, but just go for the long haul. Don't know if that over the long haul, you should do well there. But when it comes to real estate, I mean, this is really going to be the thing to think about. And what I'll typically say about real estate is it's a multifunctional asset. It's not typically one dimension. It's not, the average cost of a home in the US is 330 grand. And that's what the cost is. It's multidimensional, meaning you don't have to pay 330 grand, for example, all up front to control that asset. You only need to put 3 to 5% or 25% if you're investing to control that asset. So that means that we do think that there's going to be continued appreciation, probably 5 to 8% over the next year, and maybe go down a little bit from there. Well, you get 5 to 8% appreciation on the whole asset cost that you're controlling, not just on the amount you invested. Okay. Then the second thing to think about is you're actually paying down the debt where your tenants are over time. So every drop in the bucket that they sign that you pay that mortgage, a couple $100 or a couple $1,000, depending on how many you have, is going back towards your net worth, and you're paying that down. The other piece to think about here is the interest rate. I mean, that one, you can deduct that on your taxes, and two, this is below the rate of inflation. So what does that actually mean? Well, that means that the physical building is an asset, but the loan that supports it is a fixed interest rate asset as well. Like the loan is actually an asset. Why is that? Well, because instead of paying $330,000 up front, in today's money, which has the most value, you're able to drip that away. And over time, inflation will chew up the value of that. So you're essentially locking in the price to pay for gas. If you think about it this way, I always tell people, think if you could lock in the rate for gas for 30 years. Well, by the time you're on year 25, 25 cents, it's, even though you're paying $5 a gallon, it might feel like 25 cents, right? Just because the value has been debased over time. And instead of paying it all up front, like some people do with all cash, you're dripping it away little by little. And by the time you get to year 10, that mortgage is going to feel really small. And not to mention the asset price has probably risen up substantially by then. And so those are probably the combination of things that we're thinking about here in our portfolio as we kind of reassess where we're positioning ourselves over the next few years. We're looking at a couple of properties to purchase this year. And last year we bought 3 houses, and this year we'll probably buy 1, maybe 2, depending on how things go here. So we're going to keep diversifying, keep moving forward. The other piece that I will throw out there is kind of a bonus for you. Read this actually on some article, but I'm going to give full credit to Warren Buffett. He was being interviewed and they said, Warren, what is the best investment advice you would give somebody to navigate inflation? And I thought his response was really, really good. What he said, look, there's a lot of things I can tell you tactically, I'm paraphrasing, that you can do to take action and protect yourself against inflation. There's different stocks and strategies and things of that nature. But the best thing you can do, bar none, and I think this is a message we can all take away, is invest in yourself and increase your skill set, right? The best thing you can do right now is figure out how to negotiate a better package for yourself and either move to a better company or get better, increase your pay, get some stock options, go to a place where you have more potential for upside, things of that nature. And so I just thought that was a nice little nugget there to think about. You can always make your shovel bigger, and making your shovel bigger is a lot easier than trying to cut lattes from your diet, in my opinion. I like to go out to eat. I like to enjoy myself. I'd rather just focus on how do I become a better earner, invest a little better, rather than try to figure out how I can cut costs in my lifestyle. So anyway, if you've enjoyed this, I appreciate you sticking around to the end. Hit like, hit subscribe. If you have nasty comments, don't leave any below. If you have some thoughts or feedback, please say hi. Take care, everyone.